So this is your intercorporate investment. I'll first give you an overview of what this thing is all about. So we know intercorporate investing is one company literally investing into another company, intercorporate investment. We broadly divide these intercorporate investments into three buckets, maybe a fourth one. The first bucket is if I'm making a pure financial investment. Okay, then how do we do accounting for the financial investment part? Or if I'm making a strategic investment, I'm trying to be some sort of a associate in the company. So let's call it as a strategic investment. Or help me out. Third, I'm taking control of the company, right? So the general JV, as I said, is the fourth one. So general thought process is if it's a financial investment, you're typically looking at ownership of less than 20%. Correct? That's kind of a benchmark. If it's a strategic investment, investment in associate, that's the word curriculum uses, right? Then you're looking at investment between, tell me, investment between 20% to 50%. And if you're looking at a subsidiary, then obviously your investment range is, come on, help me out, above 50%, right? These are broadly the three buckets that I have. And then obviously we also have a joint venture. Now, please remember for the exams that these percentage are indicative. It's not the final test, they're just indicative. The true test of what accounting method to use is based on the following two words, extremely critical. First, do you know what is the word here? That is correct. It is significant influence, right? For example, imagine a situation where A owns 18% of B. So technically by 18%, it should be in this bucket. However, we get to know that A exercises significant influence over B, then we will do the accounting using this method. So this is a true test, the word significant influence. Now, there is a definition of what constitutes significant influence, but I don't think we need to bother about that for the level 2 exams. And here, to use accounting or control method, the true test is, what is the true test here? The control itself, right? If you want to scribble, it's okay to scribble. You can write maybe specific areas on your post-its or sticky notes if you have any, so that you can put them on your wall, whatever you have. But this PDF I will be sharing with you, so don't worry about that. All right. So financial investment, strategic investment, and control. Now, for financial investment, we have three broad categories through which accounting will be done. We take financial investment and we divide them into three buckets. The first one, and first we'll use US GAAP terminology, and then we'll use IFRS terminology. So first, US GAAP terminology, and accounting can be called as HTM. HTM stands for held to maturity, or available for sale, AFS, or trading. Now, IFRS has somewhat similar classification. So under IFRS, HTM is called as, that's correct, amortized cost. OCI. Financial investment, we divide into three buckets. Let me repeat that quickly now. Under US GAAP, they were called as amortized cost. Is that correct? No, HTM. US GAAP languages, HTM, AFS, and trading. The corresponding nomenclature used in IFRS would be what? This is called amortized cost. This is called what? FVOCI. And this is called as fair value through profit and loss account, FVPL. What is the treatment? On balance sheet, these assets, HTM will be shown at amortized cost. And remember, amortized cost is different than the cost. Cost and amortized cost are two different concepts. Do an example on that. AFS available for sale or FEOCI on balance sheet, this will be shown at fair value. Trading securities on balance sheet, they will be shown at fair value. So amortized cost, fair value, fair value. If a case study shows up on this section of the curriculum, it's a free brownie points for you, right? You cannot afford to get this wrong. There's simple, straightforward stuff. What do I show on income statement? Under this category, what do you think goes on the income statement? Income statement, we recognize only the realized gain. Now I'll do an example with you. You'd realize that realized gain and received in cash are two different components. So you can realize a gain but not receive it in cash. Okay, so we want to be a little careful there. How about AFS? On income statement, we will show this at realized gain. How about trading? On income statement, we will show realized gain, come on, and unrealized gain both. Realized, unrealized, both the items will go here. What will we show in OCI? We don't show anything here, we don't show anything here, but the unrealized gain gets captured into OCI for AFS securities, right? So this is roughly how accounting is done for these three category of investments. Let's do an example so that we kind of make sure we feel comfortable. I'll try to create an exam-like situation with you. Here's typically how level 2 case study will line them up. They will say there's a firm which purchased 10,000 bonds. At the time of these bonds had a face value of 1,000, and these bonds have annual coupon of 10 years with maturity of, let's assume, maturity of 10 years. At the time of issuance, okay, they were purchased yielding, or YTM was 15%. If the firm has decided to classify them as amortized cost, if that's the classification, then in year one, at the end of year one, what amount will you show on your balance sheet, what amount will you show on your income statement, and what amount will you show on your OCI in all the three quadrants? Did you understand this? And let me throw in a little bit more. I don't think this is discussed in the curriculum, but how about cash flow statement? Where and how will you show any amount on the cash flow statement at the end of year one? Do you think you can do it? Start quick. These bonds are being purchased at time zero, so just be a little careful with that. All right, here's how you're going to do it. You want to do this in two parts. Step number one, figure out what would be your purchase price of the bond at time zero, and it figure out what should be the amortized cost at the end of year one. Right? We can pull this off on TVM row. Whatever answer we get, we can multiply with 10,000. So we don't have to worry about that. Let's focus here. 1,000 future value, 100 payment, 10N, 15 IY, compute present value. 1,000 future value, 100 payment, 10N, 15 IY, compute present value. Can you help me out with what the present value will be at time zero? 749.06. Now in year one, the bond, now this, do we call this as a premium bond or discount bond? It's a discount bond. So year one, the value will go up a little bit, right? So now make 9 as N and then compute the present value. 761. Okay, 761. Now, I'm doing accounting at the end of year one. I want to put fair value on my books. So here, the value that I'm going to put, Ayush, is 761. Okay. How about income statement? Remember, in income statement, we are supposed to recognize only the realized gain. Correct? So I'm going to receive a coupon of 100. Therefore, income statement, my realized gain is 100, which is coupon. Is there anything else part of the realized gain? Yes. What is that? The amortization of discount. Okay. And what is that? Increase from 749 to 761. How much is that? Huh? 12? Is it 12 or 11.94, right? So 11.94. So my total realized gain is actually on my income statement will be 111.94. Are you getting hang of it? Which is going to be coupon received plus amortization of discount. What will I put in OCI? Nothing. Why? Because OCI, it's a amortized cost security. We don't put anything in the OCI. What will go in the cash flow statement? Cash flow statement in year 1, I will have 2 entries. At the beginning of the year, I will have a CFI outflow at time 0, but it's a part of the same year, no? I will have a CFI outflow that would be 749. And then towards the end of the year, I will have one more entry, which will be a CFI inflow. Why is it a CFI? It's an investment, right? And what is that going to be? Will that be 111.94? No, it will just be 100. That's it. This is my accounting treatment. This is how you are going to do amortized cost. Now, if you understood this well, your response on the chat box is going to be I pass every time you type this, you believe. And if you have any question, then you can just say I question. If you're struggling, you can give me a I struggle, but I hope to see a lot of passes here. Good. What's the question then? Why outflow? At time 0, when I'm purchasing the bond, I have to pay money to buy the bond. That's the outflow here, 749. Time 0, I buy the bond, so I pay money, so it's an outflow in CFI. Yeah, I mean, year 0, your first year actually is this period, no? Like when we do accounting, when we see financial statement, you see financial statement from here to here. So this will be recorded in the same year. At the beginning of the year, an outflow. Towards the end of the year, I received an inflow. Both the entries will go in this year's financial statement. The income statement is simple. I receive coupon of 100 and amortization of discount from here to here 11.94. All right. Hopefully you're comfortable with this. Now, rest of the two accounting is fairly straightforward. So, for example, let's say one more quick example so that we kind of consolidate the knowledge. At time 0, you purchased 20 shares at the price of purchase of 20 shares at a price of 30 each. Okay. At the end of the year, the shares are trading. The price of the shares is, let us say, 38 per share, and dividend received per share is, let us say, 2 per share. Now, based on this information, how will you do accounting if you assume this asset to be AFS? How will you do accounting if you assume this asset to be trading? Which means AFS means FVOCI and trading means FVPL. Now, this one I'm going to solve for you. I just want you to observe carefully. Remember, on balance sheet, we are going to show this at fair value. On income statement, I'm going to capture only realized gain. And on the OCI, I'm going to show unrealized gain. Whereas in FVPL, on the balance sheet, yes, fair value, but income statement, we are going to recognize both realized as well as unrealized gain. So here's how accounting treatment will be. So let's assume this is my balance sheet here, and this is my income statement. So first, on balance sheet at the end of the year, I will show asset as investment or financial investment, and that would be shown at 20 into, tell me how much? 20 into 30. I'm creating end of the year balance sheet. 20 into 30 or 38? Why are you confusing me? Should it be 30 or should it be 38? It's the end of the year, the balance sheet. I purchased them at 30. Now the stock price has become 38. I'm using a FVPL, FVOCI method. So on my balance sheet, should I show them at a price of 30 or should I show them at a price of 38? 38, because that's the fair value. Fair value means market value for today, right? Fair value is just the accounting lingo for market value. So I will show them 20 into the current price of 38. Is it okay? Now, on income statement, we will show some sort of a income. Now, this is a OCI method. So I'm going to show only the realized gain here. Now, what is my realized gain? Realized gain is simply the dividend. So how much dividend have I received? 2 for 20 shares. So I'm going to show a total dividend of 40. Now, at the end of the day, whatever dividend I get becomes my profit, and whatever profit I have eventually gets transferred to balance sheet equity side. So here I'm going to have a retained earnings worth 40, correct? Plus I bought the stocks at 30. The stocks have become 38. So there is an unrealized gain component of how much? 8 rupees per share into 20 is 160. So that I will show as a part of OCI, and on OCI my entry is going to be 160. So these are the entries that I will pass. Please remember, OCI retained earning is also a part of equity. So it is just internal decomposition, but at the end of the day, all the profits are accumulating in your equity. Okay. How about FVPL method? So here investment 20 shares into what price? 38. Fair value. Income statement, I will have income which is made of two parts. Realized gain, which is dividend, and unrealized gain, which is your capital appreciation. One is 40, the other one is 160. Whole profit is 200. Entire profit of 200 gets transferred to retained earnings. Retained earnings 200. Now why I'm showing you this is the end effect on equity is same on both the methods. And there could be some sort of a question on this. For example, imagine I build a scenario where I say, okay, two companies, one company decided to classify those assets as FVOCI, other one FVPL. What would be the impact on debt equity ratio? What will be the impact on debt equity ratio? No impact. Why? Because the equity in both the situations is going to be same. Is that okay? Are you guys comfortable with this? Fantastic. Glad to know. So let's make some progress. My strategy is to kind of touch base on all the important calculations that we have, and then towards the end, I will do a theory wrap up for you, right? But I'm sequentially just taking you through all the important pieces of calculations. So now let us do a comprehensive example again on the remaining methods. So in our flowchart, we did financial investment, HTM, AFS trading. Now, if you have a significant influence, can you tell about depreciation effect on this? There is no depreciation part. These are financial assets. You don't depreciate stocks that you bought. You depreciate typically your PPEs, right? Okay. Now here, significant influence, the method of accounting proposed here is called equity method. Okay. Now we will do an example on equity method. Can you tell me how does equity method work? On balance sheet, what do we show? Under equity method on balance sheet, we show a single line investment. You know? We show a single line investment. What is that called? That's called investment in associates. That's it. One line, end of the story. Then how does this investment change every year? So every year, this investment will increase by whatever investment I had at the beginning. Every year, this investment will increase by, correct, the proportionate share of associates profit. Krishna. For example, I made an investment of, let's say, 10,000 rupees into some associate. Now, first year that associate made a profit of 1,000, 30%, if I'm assuming I own 30%, 30% of their profits will be shown as my profits, and my asset value, the investment value, will increase by proportionate share of associates profit. What will my investment value decrease by? It will decrease by dividend received, and then there is also one technical adjustment here. It will also decrease by, correct, depreciation on excess of, come on, excess of fair value over book value for certain depreciable assets. Now, in candidate resources, there was one case study that a candidate came to me, you want to discuss. One beautiful trick that they had inserted here is that, and I'm going to create a similar question. When you're paying that excess, if some part of that excess that you've paid of fair value or book value, and that happens to be assigned to land, then on the land component, there is no depreciation. So it's not that on the entire excess you charge depreciation. You also need to see where that excess is being assigned. I'll show you that. Okay, so this is roughly my treatment on the balance sheet. How about income statement? What's the treatment? Do we take proportionate share of profit on the income statement? Yes. Yes, Rohan. The proportionate share of profit, proportionate share of associates profit, that comes on the income statement, proportionate share of profit. How about dividend? Do we record dividends on the income statement? No, no dividends, right? Dividends are not recorded as on the income statement because you don't want to double count the same profit, correct? So dividends will not be recorded, and I think everything else is okay. Let's do an example. Let's see if we can solve a question here. Equity method. Since I'm constructing a question, I'll try to create one for us. This is the balance sheet of the associate at time 0. Let's say they have equity of 1,000. They have debt of 1,000. Let's call this long-term debt. They have property, plant and equipment of 1,000. I'm going to record land separately. They have land of 500. They have inventory of 250. And they have cash of 250. So our balance sheet is tallying up at 2,000 each. Let us say acquirer paid 700 to acquire 30% ownership in the entity. The fair value of these assets, property, plant and equipment, the fair value is, let us say, 1,500. Land, fair value is 900, and obviously inventory and cash, we'll just keep them same. Okay. Acquirer paid 700 to acquire 30% ownership. PP is to be depreciated over 10 years. The first year, associate profit was 800. First year, dividend paid by associate. Okay, this is total dividend paid by associate. Keep it at 300. Now, based on this information, here's what you're going to do. A, first you're going to figure out the composition of this 700 that we paid, of 700 paid, right? How much of that is assigned for what category of assets? Then second, you're going to figure out what should be the balance sheet value and income statement value of this investment in associate at the end of year 1. You understood the question? So we have balance sheet of the associate with some characteristics. Then at time 0, acquirer pays 700 to acquire 30% ownership. 700 is a little less. Hold on a minute. Let's increase this to 1200. Okay, so that we get some goodwill as well. And then PP is to be depreciated over 10 years. First year associate profit was 800. First year total dividend paid by associate 300. So please do decomposition of this 1200 and then figure out what should be the balance sheet value and income statement value at the end of year 1. Start. Come on, pick up some speed. I'm expecting you to participate in all the numericals that we're doing. So please make sure you sitting with pen and paper and you're solving all the questions along with me. Is it done, Ayush? Come on, pick up some speed. Are we done? Do you need time? Give me an update. What's happening? Okay. All right. Let's see if we can solve this together. All right. So the compensation that I've paid is 1200. This is the comp which has been paid. Now, some part of that I'm going to assign towards book value. Some part of that I'm going to assign over excess of fair value over book value. And then whatever is the remaining amount, I'm going to do the goodwill. Shala, see if you can capture now. All right. So look at this carefully. It's fun. What's my book value? Book value is right here, just 1000. Okay. So the total book value is 1000. Now, how much of that is assigned to us? We'll worry about that in a bit. What is excess of fair value over book value? On the exam, you would see this clear pattern. There would be 1 or 2 assets which will have a difference. So here, excess of fair value over book value, 500 for PPE. Do you agree? So total PPE, excess of fair value over book value, 500. And what else do we have? We have land. We have land, which is going to be 400. So the total here is 900. Now, what they will do on the exam, typically land also is a part of PP, right? Here I gave you differently. What they'll give you on the exam is they will say, hey, total PP originally is 1500. Excess of fair value over book value is 900, which is made of 500 for PP, 400 for land, right? That means this will be combined together. So you need to kind of divide this into 2 parts and then goodwill. Now, I own only 30% of that entity, correct? So therefore, the amount of value that I'm going to assign here is going to be 30%. So this becomes 300. 30%. So this is 150. 30% here. So this becomes 120. And then what's the total? 300 plus 150 plus 120. How much is this? 570. But I paid 1200. So the differential 630 becomes the goodwill. This is the plug. I'm writing the calculations here. I did this as 1200 minus 300 minus 150 minus 120. This is how that 630 is arrived. This is my goodwill. How many of you got this right? Give me a I pass on the chat box. If you got this wrong, give me a I struggle or I question. No. Okay. All right. So the decomposition is ready. So let's do accounting now. Excluded cash from book value calculation. Same the book value part. Got it. Yeah. Could you please mention about land being clubbed as a part of PP? I missed that part out. See, generally on the exam, Rahul, when we prepare, even in practice, when we prepare PP schedules, land are included in PP. Here I give you separately. On the exam, they will just give you one combined number of 1500, and then they will say that the total excess value is that 900, which is here, 500 plus 400, and then you just need to figure out how much of it is for land, how much of it is for PPE. That's it. Book value is just equity. All the assets minus all the external liability, that's nothing but your equity. All right, everyone, be with me now. Focus. Investment in associates. the beginning of the year, that number is going to be on my balance sheet. How much? 1200, right? A single line item. Even though we have goodwill, do we write goodwill separately? No, right? We don't write goodwill separately. It's included in that 1200. Now, how will that 1200 increase? So first, plus proportionate share of associates profit. Proportionate share of associates profit. How much is that? 1000 into, sorry, how much is profit? 800. 800 into 30%. That would be how much? 240. All right. Minus dividend received. Dividend received is a negative number here. It's almost like eating some part of your asset. Okay. So total dividends paid are 300, 30% of that. So dividend received 90. And then very importantly, depreciation on excess of fair value over book value. Fair value over book value, how much was that? How much did we assign to this? 150. We're going to depreciate only on 150, not 500. We will not be depreciation. And I think when last time I was teaching this in the class, I did have discussion on this, right? It makes no sense for me to depreciate the whole 500 when I'm buying only 30% of the assets here, correct? Under associate method, I will depreciate only my part, which I'm paying for. I'm paying for 30% of the assets. And this is how I'm doing accounting. So this 150 is what I need to depreciate. So 10 years, 150, Pranshu, that means my depreciation amount becomes how much? 15. Now, is this depreciation recorded on my income statement? No, right? I don't record this depreciation on my income statement. So my balance sheet items are like this. At the end of the year, the balance sheet value will become 1440. How much is this? 1335. So this is my closing value. Closing balance sheet value. All right. And what happens to the income statement? So income statement, I will show income from associate. Help me out. How much? Income from associates. How much? 240. I don't think it's 240. I think it should be 240 minus 15. Less the share of depreciation 15. So the amount of profit should be 225. Income from associate share less that excess of depreciation 225 is what would be reflected on my income statement, because there is a second entry for that 225 which is here. That's how my books will tally. Otherwise my books will not tally. There's a second entry for dividend received also in the cash. Imagine on the income, if I were not to show that 15, my balance sheet will not tally, right? Debit credit needs to match somewhere. Can you explain the depreciation part, Amol? See, that part of PPE, which is excess of fair value over book value 500, I have recorded 150 of that in my decomposition. On this 150 for 10 years, we charge depreciation. You also show cash item on the balance sheet? Sure. Yes, you can show cash received of 90. Then depreciation should be shown separately in an income statement? No. We don't show depreciation separately on income statement. We show income from associate 225. Why is depreciation reduced in the income statement? Is because my net profit to me coming from my associate is 225, because I have to account for that 15 of depreciation, which is associate's asset. Why don't we add dividend on the income statement? Is because I'm adding profit directly. Adding dividend would account to double. See, dividend is some part of that profit, no? If my associate gave me a profit of 240, and if I recorded the whole 240 in my books, if I take dividend again, the same profit I'm considering twice. So either you treat this as a financial investment where dividend is your income, or you treat this as an associate where their profit is your income. Then you don't take dividend as income again. You can't do both. It just makes no sense. How to calculate 15? 150 divided by 10. Why 10? PP is to be depreciated over 10 years. Depreciation is already reduced in profit, no Christo, because see, think about it. When associate is doing accounting, right? See, when I'm buying 30% doesn't mean they don't do their business. They are doing their own business. For them, I'm just a shareholder. When they do their accounting, on what amount of PP are they charging depreciation? They are charging depreciation on 1000. But when I purchase 30%, I assume that their PPs are worth 1500. That means that there is that 500 excess. Now, ideally, there should be a depreciation charged on the whole 500, but hey, I'm buying only 30%. So my share of excess of fair value or book value is 150. On that 150, I will be charging 10 year of depreciation. That will be 15. What about the cash? What about the cash? We don't know what was my opening value of cash, but whatever was my opening value of cash, my cash will reduce by 1200 and my cash will increase by the amount of dividend that I've received. That's it. What do you think, guys? I pass, I struggle. Okay, good to know. Yeah, so if you've understood this, I think equity method you are more or less comfortable. There are some theoretical nuances we need to do, which I'll be doing towards the wrap up at the end of the reading. Let's do the next section now, which is accounting for acquisition, right? Or accounting for control. So, accounting for control, there are two accounting methods. One is called pooling of accounts, and this is called purchase or acquisition method. Pooling of accounts, what about it? We don't use it anymore, right? Pooling of accounts is thing of the past, but we just need to know that there used to be a thing. Now we focus on the purchase or the acquisition method. And the difference between the two is this accounting method in the past used to allow you to consolidate assets over book value. That means it was okay to completely ignore the market values or fair values. But in this method, all assets and liabilities, we record them at fair value, right? That's the main trick. Now, within this, there are two ways in which this can change. Your acquisition will change because there is either a full goodwill that you can calculate or there can be a partial goodwill. Now, typically full goodwill is preferred under US GAAP and partial goodwill is preferred under IFRS. Okay, so let's do a super quick example of how this will look like. This is your balance sheet of the, I think I will need two balance sheets now to do a full consolidation. So this is going to be the balance sheet of the acquirer and this is the balance sheet of the acquiree. I'm trying to put in 2-3 different variations into it so that all type of possible questions gets covered in one case study itself. So let's throw in some equity. This is a larger company, so I'll put an equity of 1000, debt of 5000, 15,000. Let's create PP of 5,000 and let's have a lot of cash on the book, 10,000. All right, so this is starting at 15,000. Let's go a little more nuanced here. Let's have equity of 2,000. Let's have debt. Let's have long-term debt of 1,000. And let us have accounts payable of another 1,000. So we have 4,000 total here. Let's have a goodwill here of 500. Let us have PPE of 1,000. Let us have accounts receivable of another 1,000. And then remainder amount I'll throw in cash, 1,500, 2,500. Kitna reh gaya? 1,500. So this is 4,000. Let's give them some fair values. Fair value. Fair value of goodwill is 1,200. Fair value of PP 3,000. Fair value of accounts receivable 800, and then there is also a unrecognized liability at the time of acquisition towards employee comp. The accountant was too lazy maybe. So unrecognized liability of employee comp of 500. Okay, so this is the data that we have. Let's assume we are going to acquire 70% of this entity at, let me just run a quick mental math on this. Let's do that acquisition at 6,000. In fact, let's round it off to 7,000. We have cash in which case. So now the acquisition has happened at 7,000. Now what I want you to do is, I want you to consolidate the balance sheet and prepare a consolidated balance sheet using, you have to do it twice, using full goodwill and partial goodwill. You're going to do this 2 times. Full goodwill, partial goodwill, the entire consolidation. If you can solve this, I think that whole control part is more or less over for us now. Come on, pick up some speed. I'll give you a hint. When you're figuring out goodwill, make sure you find out fair value of net assets. Which assets? Fair value of net dash assets. Fill in the blanks. Which assets? Identifiable assets of the acquiree. So if you're looking at fair value of identifiable assets, there is one asset on the acquiree books which is not identifiable. Which asset is that? Goodwill. So the trick in this question is that when you're solving this, just ignore this nonsense. The book value of the goodwill doesn't matter. The fair value of the goodwill doesn't matter because goodwill is not an identifiable asset, right? So that part you ignore and then you solve everything else. You should be able to get this right easily. Are you done? Okay, let's do it together. Step number 1, let's just list down fair value of net. When I use the word net, it simply means asset minus liability. So fair value of net identifiable assets. All right. So here's how it's going to be. First, I will take PP 3,000, accounts receivable 800, cash 1,500, cash 1,500, then debt 1,000, AP 1,000. Since I'm using the word net, so I have to reduce the liabilities. AP 1,000. Is there anything else I'm missing on here? Yes, the unrecorded liability, right, towards employee comp. How much was that? 500. All right, and then once I take a total of this, help me out, how much? 5,300 minus 2,500, how much? 2,800. 2,800, this is the fair value of net identifiable asset. Net identifiable asset. How many of you got this part right? Okay, good. So if you got this right, then more or less, I think this question gets solved here itself. What you do next after this is, you say, okay, I'm buying 70% of that entity. I'm doing full goodwill, by the way, for you. Full goodwill. I'm buying 70% of the entity for 70%. Now, those of you who don't know this calculation, please be with me on this. It's very simple. No formulas required. For 70%, I'm paying a valuation of 7,000. Correct? That means how much is my valuation for 100%? So we do the reverse calculation, and then the valuation of the business turns out to be 10,000. I will say less fair value of net identifiable assets. Fair value of net identifiable assets are 2,800. So the entire excess amount, where is this coming from? If I'm valuing the business at 10,000, fair value is 2,800. Where is that excess amount coming from? It's coming from goodwill, 7,200. This is called the full goodwill. This is the goodwill we use in US GAAP. Now, how would we do this in IFRS? So in IFRS, we will say, okay, the fair value of net identifiable assets are 2,800. 50% of this should be equal to 2,800 into 70%. How much is that? 1,960. So ideally, this is the amount I should have paid. However, consideration paid was how much? 7,000. So then excess paid. This excess amount paid is your goodwill. Okay, so 7,000 minus 1,960 is 5,040. This is my goodwill under the partial goodwill method. Now, if you just know how to do this, and someone says, I don't know how, Shraddha, keep it on hold, I'll explain again. But if you can just figure out this, here's a cool trick for you. You probably already know it, but if you don't, if I take this full goodwill, and if I multiply this full goodwill with 70%, it should give me partial goodwill. Right? Because that's what it basically means, that in one case, I'm going to add the whole 100% of the goodwill on my books. In one case, I'm going to add only the 70% of that part into my books. So which basically means, if you just know how to do full goodwill, you can always figure out how to calculate partial goodwill. Now, purchase consideration is 7,000. Apologies for my handwriting, but it is what it is. Too late to change for me now. So, those of you who don't know how goodwill is calculated, someone asked, right? Who's that? Shraddha. Shraddha, so did you understand this part? How to get fair value of net identifiable assets? Right. Okay. So, which in a simple language means, this business has assets which are worth 2,800 today. Okay. Now, I am paying 70% to acquire. I'm acquiring 70% of the business for 1,000. So the way we used to do it in school, Shraddha, for 70%, I'm paying 7,000. How much for 100%? Cross multiplication. Correct? So how do we do this? We say 7,000 into 100% divided by 70%. So the valuation of the business must have been how much? 10,000. So then the logic is, if the valuation of the business is 10,000, however, assets of the business are worth only 2,800, then where is that excess valuation coming from? So that must have been goodwill, which is the difference of these two, which is 7,200. That's your full goodwill. When you have the full goodwill, you multiply that with 70%, 60%, whatever the ownership, you have your partial goodwill. Is that okay? Is everyone comfortable? Full goodwill, partial goodwill, easy? Fantastic. So now we need to do that consolidation. Here is how we're going to do it. Let's prepare this balance sheet here. Now I'm going to show you another cool trick, Ayesha. So this is consolidated balance sheet, full goodwill. And this is consolidated balance sheet, partial goodwill. All right. Now, let's write down all the consolidated assets. Step number 1, PPE. So I have PPE of 5,000. Correct? My own PPE was 5,000. Plus, I acquired PPE at fair value of 3,000. So total PPE becomes 8,000. Is this full consolidation or partial consolidation? No. My question is, like, how we have full goodwill, partial goodwill, no? In one case, we are adding only the whole of goodwill of the company. In one case, we are adding only 70% of the goodwill. When I add other assets, should I add 70% of 3,000 or the 100% of 3,000? 100%. So for all other assets, we are always full method. So only for goodwill under IFRS where we use partial goodwill. Getting it? So now I'm just going to add the whole of 3,000 here. 5,000 plus 3,000, 8,000. So PPE 8,000. Leave some space here. PPE 8,000. PP 8,000. I'm writing it both the places. It's same. Then next, I have accounts receivable 800. So let's write down accounts receivable 800, AR 800, AR 800, AR 800. Next, I have cash of 10,000. However, out of that 10,000, I paid 7,000 to the acquisition. I'm left with 3,000. But this 1,500 I will also be adding to my books. So total cash became 4,500. So cash 4,500, cash 4,500, cash 4,500 in both the books. Okay, let's go to the liability side. Debt 5,000 and this debt 1,000. So debt becomes 6,000. Remember, we do not horizontally add equities, right? So debt becomes 6,000. So I'm going to write down debt of 6,000. Then let's check what else do we have. We have, sorry, jump the question. Then we have accounts payable 1,000, unrecorded liability 500. So let me write both of them together. Accounts payable 1,000, debt 6,000, accounts payable 1,000, and then unrecorded, that employee liability. Let me just call employee liability of 500. 500 thano? Employee liability of 500. Up to this, balance sheet on both the sides will be same. First difference will come in the goodwill amount. Maybe we should also write down my own equity. And my own equity. Equity 10,000 was my own equity, so I should write down equity of 10,000 on both the sides. Equity we do not add horizontally. Okay, now goodwill. In full goodwill, I'm going to write the entire amount of 7,200. Okay, partial goodwill, I'm going to only write down 5,040. But then how will my balance sheet tally? Because the second corresponding effect comes in this minority interest. All right. What is minority interest? That part of the subsidiary that I do not own. The trick you're going to remember is to calculate minority interest is going to be what was the valuation of the, it can be used as a plug figure, but this is the right way to do it. What was the valuation of the business into 30%. So in full goodwill, I valued the business at 10,000. So 10,000 into 30%, this minority interest is 3,000. Whereas here, the valuation of the business is actually nothing but fair value of the assets, because that's how you're doing it in IFRS. Fair value of net identifiable assets into 30%. So fair value of net identifiable assets are 2,800 into 30%. How much is that? 840. So 840 is the minority interest here. And now we are done. If you take a total, balance sheet will tally on both the sides. Can you please help me take a total on the left hand side? How much is it? 816 20 And how much is the total here? Done. I pass or I struggle? आपका आया था कृष्ण? दोनों? All right. Partial goodwill, minority interest, Shraddha, is valuation of the business into 30%. Under IFRS, that valuation of the business is fair value of net identifiable assets, 2,800 into 30%. 2,800 into 30%. In IFRS, full goodwill is also allowed. Yes, IFRS full goodwill is. I think once we go to juice notes, we'll do all those theory nuances. I'll ask you to memorize those specific instances. Partial goodwill mein why we took 8,000. Partial goodwill mein why we took 8,000. Which 8,000 did we take? Sorry. Yeah, so that full or partial, who asked that question? Mamta. See, Mamta, that partial or full is only with respect to goodwill, not with respect to other assets. For other assets, we have to add the whole of 100% of the assets. Only the goodwill part is partial. The whole method is not partial. So if you notice, all other assets are same. PP is same, AR is same. I'm going to add my assets. It's a horizontal consolidation. My assets with assets of the associate, the subsidiary. Just add them up. The only difference under the two method is your goodwill number is different, and eventually, because by virtue of that, minority interest is different. We issue new shares to 7,000 is added to equity. What is that? Issue shares kahan se aa raha hai? What if we issued shares to acquire? Yeah. So what if, okay, I think I remember now. What if your acquisition is not a cash acquisition? What if your acquisition is through issuance of shares? What does change? Nothing changes. You just don't deduct the cash. Instead, you increase the equity. Effect is same, no? Cash will remain same, but equity will increase by whatever amount of shares you've issued. That's it. Otherwise, accounting will still be same. All right. Okay. This is done. Now there is just one more small calculation left that I need to do on this whole, it's the same one, upstream and downstream thing. Upstream and downstream calculation. Now see, what you need to know on this is you just need to know the focus here is you need to know the amount of profit reversal entries that needs to be passed. Right? That's the calculation that you would be tested on, amount of profit reversal. And a very cool trick on the exam, if you get confused with this, is you want to multiply everything that you see in that paragraph. This will work in most of the cases. Okay, everything that you see on the paragraph, you want to multiply them. All right. Now, what do I mean by this? So let's do, what do I even mean by upstream and downstream calculation? So here is what I mean by this. Let us say that there is a subsidiary, and that subsidiary happened to make some sales to the parent company. This is called an upstream transaction. Or the parent company happens to make some amount of sales to the subsidiary, then this becomes a downstream transaction. So name itself kind of gives it away, no? Upstream, upar bech raha hu, downstream. Technically for you, the eventual profit reversal calculation is going to look same. Let me do an example of a downstream transaction with you. Okay. So imagine we have a parent company P, and we have a subsidiary company S. All right. Now, during the year, parent company sold to subsidiary company sales of 10,000. The cost of these goods to the parent company was 6,000. Okay. And therefore, currently, parent company has how much profits in their books? They have profit of 4,000. Now, parent company owns, I'm going to make a random number, let us say 60% ownership. Now, out of the 10,000 worth of goods received by the subsidiary, they further sold it to others. How much did they sell? They sold 80% of these goods. So I'm repeating one more time if I've confused you with this. Parent company sold 10,000 worth of goods to subsidiary company. The cost of those goods was 6,000, and therefore parent made a profit of 4,000. Now subsidiary company received those goods. Now for them cost is 10,000. They sold it further to other entities. We don't know at what price. At this moment, we don't care. But 80% of those goods are being sold to others. 20% are remaining unsold. Okay. So in the accounting world, this 80% of sales made, this is called confirmed sales or confirmed profit. This 20% is called unconfirmed. So then how much of this 4,000 profit you need to reverse? That's the question we want to ask. That this 4,000 profit, some part of it I need to reverse. Okay, how much will I reverse? So here's how much you'll receive. You will say 4,000 is the total profit I've earned by selling to subsidiary, but hey, I own only 60% of that subsidiary. So when I'm selling to my subsidiary, technically it's like 60% of the sales I have made to myself. 40% of the sales I've made to others, right? So this part of the sales that I've made to myself, that part I need to reverse because I cannot make profit by selling to myself. So into 60%. Into subsidiary in turn sold 80% of those profits. So that's confirmed. So that's good for me. Only the unconfirmed part is what I'm worried about. So that part I need to reverse. So into 20%, done. So 4,000 into 60% into 20%, how much is that? 480. So the profit reversal entry that I will pass is 480. Now, does it mean this 480 will never be recognized? No, it will be recognized next year. So next year when the subsidiary happens to sell that remaining 20%, then I will recognize this 480. That's it. Is this making sense? Are you comfortable here? Okay, fantastic question. Just put it in the chat box. Sir, in accounting word, we do the reversal of 800. Kaap 800 aaya? Where is the 800 coming from? We do reversal of 480. 60% logic. It's 60% Sakshi is the ownership of parent company in the subsidiary company. So that ownership. The logic is, since I own 60% of the subsidiary, 60% of the subsidiary is me. So I cannot sell profit by selling goods to myself. What is multiply everything on the question? The amount of profit reversal is multiplying everything. 4,000 into 60% into 20%, that's the amount of profit we need to reverse, 480. So कहाँ से निकाला है इसने यार? अच्छा 4,000 into 20%. नहीं वैसे नहीं होता. Because 40% of the subsidiary is not me, right? So that part of the profit I want to recognize. It doesn't hit any of my ledgers. I'm just recording a proportionate profit of the subsidiary in my books. Okay. All right, let me wrap up the theory super quick now. I think I've covered all the calculations. Do you still have stamina to go on and finish the theory? I was planning to do 2 LMs today. It doesn't look like I'll be able to do it, but at least we do this well. So let me finish the theory with you. I'll only focus on the sections which I feel is important. Okay. Keep your questions on hold. Ask me towards the end if you have time. Let me just finish in the sequence, please. Now, let's try not spam the chat box. Come on, be with me. I will highlight important theory points. If you have something to write, you can write this along with me. This flowchart from juice notes we've already done. Amortized cost, FVOCI, FVPL, equity, consolidation. This part we know, realize, unrealize, that is okay. Now, that significant influence, does it have a definition? Yes, this is a broad definition. So just quick pointers for you to look at. If you have a BOD representation, policy making involvement, intercompany transaction, interchange of managerial personnel, dependence on tech, this is the definition for significant influence. Then joint venture, what accounting method do we use? Under both IFRS, US GAAP, we use the same equity method. Some rare cases, you're also allowed to use a proportionate consolidation. Okay, so for all practical purpose, equity method is what you need. IFRS as well as US GAAP. Amortized cost example we've done, so I'm not going to spend time on that again. Okay. Then, if you are going to classify certain security as a debt security, this is a new section we've added to the juice notes, by the way. Some of your versions might have them. So if you have a security which is to be called as debt security, it needs to meet following 2 criteria. So know this for a theory question. Number 1, there is a business model test, and then there is a cash flow characteristic test. You need to know both. What is a business model test? Debt securities are being held to collect contractual cash flows. That's your business model test. What is a cash flow test? These cash flows are either principal or interest on principal, but not anything else. For example, what if there is a security that pays you share of profit? Is that considered debt? No. Why? Because it is not meeting the cash flow characteristic test. So business model test business model test means I have purchased this to receive contractual cash flows. And cash flow characteristics, the contractual cash flows happens to be interest or principal, nothing else. So I bought it so that I receive the cash flow, and cash flows happens to be interest or principal. That's it. These are the two tests that we need to be aware of. Then only a security can be classified as a debt security. This is another theory point. You need to know this. Derivative accounting is complicated, but derivatives which are non-hedge derivative, not used for hedging, we always treat them like FVPL. For hedge derivatives, the accounting is different. For derivatives that are not used for hedging, we use them as FVPL. An asset has a embedded derivative. Okay, for example, something like a convertible bond, then the entire asset becomes FVPL automatically. Look out if you get a vicious question writer on the exam who throws in that, hey, there is a convertible bond that an entity recently purchased, and now the accountant says we should treat this, we intend to hold this till maturity, we should treat this as amortized cost. The intern says, no sir, I think the correct way to treat this should be FVPL. And then you have a question, who is correct, the boss or the intern? So the logic is that if you have some asset and along with that you're getting an embedded derivative, typically a convertible bond, then by virtue of this derivative, this entire asset you need to treat as FVPL. Okay. Equity security that you're going to hold for trading automatically are FVPL. Other equity, you can either do FVPL or you can through OCI. Choice is irrevocable. So remember this word, irrevocable. So which basically means, and it's logical, this is saying you cannot put equity in amortized cost because there is no concept of amortized cost for equities, right? So equities can go either in FVOCI or FVPL. You choose at the beginning, you cannot switch later on. Whatever you choose, it remains there forever. Then reclassification. It's a little heavy, but again, my recommendation, write it on a post-it and revise it. If a question comes, a lot of level 2 candidates are going to get this wrong. It becomes your competitive advantage, right? It's a little bit memory heavy, but you need to memorize this. So reclassification. Reclassification of equity under new standard is not permitted. We just discussed. Choice is irrevocable. So that is okay. Reclassification of debt is permitted only if the business model has changed. For example, unrecognized gains and losses on debt securities carried at amortized cost and reclassified as FVPL are now recognized in the income statement. Now, what does this mean? Remember earlier we had that business model test and cash flow characteristic test. Under business model test, we said I'm buying them because I want to receive contractual cash flow, and cash flow test, contractual cash flow is interest and principal. What if I bought the bond and now I feel that, hey, I don't want to keep it till the end. I want to trade. YTM has gone down, bond price has gone up. Ab meko bechna hai. I want to sell this now. So my business model has now changed. Earlier it was to receive contractual cash flow. Now I am opportunistic. I want to make a profit and sell it. If that happens, then it's okay to move them from amortized cost to FVPL. Okay. However, under amortized cost, remember under the amortized cost, that amortization component, coupon was recognized on the income statement, and that amortized component over a period of, for example, let us say it's like this. This is year 1, your amortized year 0, year 1. You bought the bond for 700. Year 1 amortized cost has become 750. Okay. Now year 1, what went on income statement? On income statement, you recognize coupon of, I'm making up 100 plus amortization gain of 50. Is this okay? Now, this is where you decide that I need to make a transfer. Now, this 150 is already booked into income statement, so you have nothing to worry. However, market value of this bond today happens to be 900. So what you do now, you change the asset value from 750 to 900. And that 150 difference, you put that in the P&L. Why? Because now it has become FVPL. So FVPL, realize, unrealize, all the gains now go to income statement. And if you didn't understand that part, it's okay. Just know it's okay to move debt securities from amortized cost to FVPL. Debt securities that are reclassified out of FVPL and measured at amortized cost are transferred at fair value on the transfer date, and that fair value will become the new carrying amount. So which means debt security, am I allowed to go from amortized cost to FVPL? Yes. Am I allowed to go from FVPL to amortized cost? Yes. When this transfer happens, whatever was the fair value on the date of reclassification, that becomes the new amortized cost here. Okay. This part we've covered. So I'm moving on. Impairment, you can look this up. The most important part is now we've moved to a ECL model. Okay, look out for a theory question. This can really, blow you away on the exam if you haven't read through this section. Now, let me explain what this means. And when this came, it was a big thing in accounting, right? There was a lot of debate in the market on ECL is coming. Earlier, the model was an incurred loss model. What does it mean? So imagine, okay, and that bond is worth 1,000, and there is no indication, there is no credit event, everything is going well. There's no reason for me to recognize expected loss. If I purchase a bond, that company is paying me interest on time, I'm okay. However, under the new IFRS model, IFRS 9, you don't have to wait for that loss to trigger for you to record. You have to create a provision. How is to create provision for doubtful debt? So you have to do probability of default into loss given default into exposure amount. It's something from your fixed. And you say, you know what, even though the company is not defaulted, my calculation is telling me that my expected credit losses are 20. So I'm going to recognize this book at 980. That 20 I'm going to show as a loss on the income statement, even though the default has not happened. But it works a little bit like that provisioning system. Have you understood this? So this is a big thing. We've put this twice in the juice notes, once here and once right at the bottom of the reading. So keep an eye on this. The same sentence. Companies have migrated from incurred loss model to expected loss model. All right. Let's see. Have we covered all the theory for you? This part we've done. Investment associates, that's taken care of. If there's a cost above the book value, we assign that to fair value. This part we need to do. Remember, sometime back we learned equity method of accounting. Now, let's say a scenario like this. I go and buy 30% shares of some micro cap company. Okay, so let's say we identify some opportunity and we buy 30% of some company, but I don't want to do that business. I'm not interested in the business operation. For me, it's a financial investment, even though I've purchased 30%. All right. So then can I go to the accounting standard board or regulator and say, hey, I don't want to use this equity method of accounting because they're honestly not my associate. I just want to show them as fair value. Can I do that? The answer is yes, because the accounting standards allow you to record under equity method. That means under significant influence if you want to record them at fair value. That means all that accounting nonsense, goodwill, excess of fair value or book value, nothing is required. I will show them all my assets at market value of those shares. Market value goes up, I will show them higher. Market value goes down, I will show them lower. This is called the fair value model. Now, is it available to everyone? US GAAP, yes. IFRS, no. In IFRS, it's available only to VCs, MFs, unit trust, or investment companies. Can I change from one to one? No, irrevocable. Once you choose, you're stuck there. And then where will unrecognized and unrealized gains go? They go to income statement. This is the fair value option. All right, impairment part. I think I'm going to skip through this. We'll do impairment a little later. This is your elimination of profit. How do you do elimination of profit? Unrealized profit into percent of shareholding. How do you get unrealized profit? Profit margin into unsold inventory. Right? So same thing that we just did. Just multiply those three numbers, you're okay. This part we discussed. Acquisition, pooling of interest. This is the old method. We don't use it anymore. Full goodwill, partial goodwill we've discussed. This is just an example in the juice notes. Yes. The minority interest is part of equity under both IFRS, US GAAP. You kind of know that. For contingent liabilities, we have a flow chart below. So we'll deal with that there. Okay, there's a little bit of goodwill impairment. I think we should spend some time on it. How is it, Josh? Are you still absorbing? So let's do goodwill impairment. See, what goodwill impairment are we talking about? This is a goodwill impairment under the consolidation, jo control method that we did. Okay, it's a little technical. This example will help you. Okay, we'll directly jump on the example. If you have access to juice notes, that's great. If you don't have access to juice notes, you can take a screenshot here. This example will help you revise this. Now, let's say I have a carrying value of cash generating unit or reporting unit. That's like a technical term in accounting world. Inclusive of goodwill worth 1400. Now, currently recognized goodwill on the books is 300. Fair value of the assets are 1200. And the recoverable amount, if I were to sell them today, I should be able to recover 1300. The way we do goodwill impairment under IFRS is we say, right now, I'm showing my carrying value at 1400. However, if I decide to sell this business unit, I will get only 1300. That means I need to recognize an impairment loss of 100. So IFRS has a very logical, structured way. My business is worth 1400 in my books. If I sell the business, I get 1300, so 100 of loss. And that loss, obviously, I'm going to charge to my goodwill. So therefore, I will reduce goodwill by 100. So my goodwill now becomes 200. Okay. So IFRS is straightforward. US GAAP gets a little technical. US GAAP generally does it in 2 steps. Okay. It says step number 1, compare carrying value to its fair value. Then calculate the impairment loss, which is difference between implied fair value of goodwill and the carrying value. Let me show you. Fair value of reporting unit is 1300, right? That's the market value. And the carrying value of reported unit is 1400, which is your step number 1 in IFRS. Same is a step number in US GAAP, but this step just confirms that yes, impairment is to be charged. Now, how do you calculate impairment? So here's the implied value of goodwill. Look at this. 1300 is the value of recoverable asset. I can sell it for 1300, and the fair value of identifiable assets is 1200. This 1200 we did not use here. Fair value of assets we did not use here. Okay, so this 1200, so that means implied value of goodwill is 100. But right now goodwill is how much? 300. Implied value is 100. So I need to recognize loss of how much? 200. My impairment loss is 200 here. Here impairment loss was 100. Okay. Let's do it one more time. Both the methods are giving you different answer. See, let me do this again here for you. It can get a little confusing. Let me make an attempt. Okay. See now. Step number 1. What is the value of that business? Okay, whatever company that I acquired, on my balance sheet, the value of that business to me today is 1400. This is called cash generating unit. Now, the accounting standard goes at great length on defining what cash generating unit is, but CGU is 1400. We don't care about that. Now I say, okay, if I were just to look at recoverable amount means if I were to sell this, then I will recover 1300. But what if I sell only assets, not the business unit? If I were to sell only assets and not the business unit, this is 1200. IFRS follows a nonsensical approach. What IFRS says simply figure out what is the carrying value versus what is the recoverable amount. This is lower, 1400 minus 1300. So I have 100. This is my impairment loss. Okay. US GAAP doesn't do it like that. What does US GAAP do? US GAAP follows a two-step approach. Okay. Step number 1 is to determine if impairment is really required. So it's called as an impairment test. How will you do it? So you take the fair value and the carrying value. You say my carrying value is 1400 versus the fair value of the assets is 1300. Fair value is less compared to carrying value, then impairment is required. Had the fair value been higher, impairment is not required. Up to this, are we together? And ये fair value 1300 था या fair value ये fair value नहीं, recoverable amount of assets 1300. Once the answer is yes, then I go to step number 2 and I say, okay, if I were to sell this business, I will sell this business at 1300. Okay, this is my recoverable amount. But what is the fair value of those assets? If I were to sell them individually, fair value of those assets are 1200. That means my implied goodwill value in the business is 100. Does this make sense? That if I were to sell the whole unit, I get 1300, but if I were to sell only the assets, I get 1200. So I have a loss of, I have an implied goodwill of 100. But right now, goodwill recognized in my books is how much? 300. Therefore, my impairment loss is 200. This can get a little tricky because there are too many moving pieces. So the best way to do it is write this down maybe on a post-it and revise this a few times so that you don't get lost. Know that there are 2 steps. US GAAP. First, to determine if impairment is required, and second, to calculate the goodwill impairment losses. Yeah, they'll give you all the data that you have here. ये recoverable होना चाहिए. This should be of RC of RU. What? Okay, this is done. Then one more theory. We almost done. Okay, last 10 minutes. We're there. Need a little more stamina from you. Here now, what if there are contingent assets and contingent liability at the time of acquisition? Should I record them or not? Okay. Now, generally, you know the accounting rules about contingent liability. We don't show them on the balance sheet, but we show them in the footnotes. Contingent assets, we don't show them anywhere. Only when recovery is confirmed, then I record. But let's say I'm doing an acquisition transaction. Subsidiary had some contingent liability, some contingent assets. Should I record them in my books at the time of acquisition? So the answer is, if those contingent assets and liabilities are contractual, that means you have a contract that says this is how you would receive it, then you need to record them. Okay. If they are non-contractual, there is nothing in writing, but then you run the test. Is it more likely than not that I would receive the asset or pay the liability? If the answer is yes, you again record them at fair value. If the answer is not sure, I don't know, then we will not record them right now. We will wait for some clarity to come on them. So this is the metric. This is what was written, I think, in theory here in a couple of sentences. Contractual contingent asset, but I think it's easier for you to just do this flow chart. So if you have contingent assets and liability, first question, are they contractual, non-contractual? Contractual, record, fair value. Non-contractual, then run the second question. Are they more likely than not to be realized? Yes, record. No, wait. And finally, we come to SPE part. Now, this section, here's what you need to know. This VIE is a US GAAP term. Okay, variable interest entity. The question is about, should I do the consolidation or not? Okay, this is what the question is, that and this, obviously this is coming from that whole Enron nonsense, right? Everything that happened in 2008 and then Enron. So here is how you want to think about it. Under US GAAP, VIEs are SPs that meet certain business condition. Okay, what are the business conditions? Total at equity risk is insufficient to finance activities without additional finance support, or equity investors lack any one of the following: ability to make decision, absorb losses, right to receive. If these conditions are met, and look at the or here, then SP is a VIE. If it is a VIE, it needs to be consolidated. Okay, so it's a two-part rule. What? Rule number one, if at risk equity is insufficient. Or rule number two, the following three criteria, these three: ability to make decision, obligation, right to receive return. If any one of the two rule is met, it is a VIE. If it is a VIE, it needs to be consolidated. If it's not a VIE, don't consolidate. How about IFRS? IFRS says तुम खुद decide कर लो. IFRS says if as a sponsor you control, you consolidate. IFRS, remember, is a principle based accounting standard. It doesn't specify rules where it feels it's not required. So IFRS says you decide. If you control, consolidate. If you don't control, don't consolidate. US GAAP says no. I will tell you the rules. Insufficient equity, at-risk equity, or ability to make decisions. I knew that was going to come. You watched the main video. Usme hai ye. But someone asked me what is the meaning of insufficient at-risk equity. So it's actually coming from those popular structures Enron built. So I'll give you a simplified quick example. It's like this. I want to create a subsidiary. I will give 99.99% ownership to you, Ayush, and you have to pay a nominal amount. Okay, I will have 0.01% ownership. However, there will be clauses where I will also become a bondholder. All the losses will be absorbed by me before they come to you. Okay, and your risk will be limited only to the extent of amount, and you will be investing a very nominal amount in the business. Entire risk is absorbed by the bondholder. All the contractual obligations are dealt by the bondholder. But legally you would look the owner, but in reality I will be the owner. Your profit will also be restricted to some amount. So what you do is you create a contract where bondholder has a lot of rights. Shareholder doesn't have a right. Shareholder doesn't pay a lot of money. And that way, Enron somehow got away with consolidation. So US GAAP said, okay, fine. If at-risk equity is insufficient, you still consolidate. Okay. If something goes wrong, Ayush is not going to lose money. Bondholder will have to come in. Okay. And there is more to it. I just give you like a overview of it. Yeah, entity that absorb losses must consolidate. Same stuff. The one who's going to bear losses if things go wrong is technically the owner of that business. For example, if that entity is doing some business and I go to lender and I say, if something goes wrong, it's my responsibility. Let's make a contract. So even though I'm a bondholder, I'm taking responsibility for business going wrong. So the one who absorbs losses is the one who should consolidate. And finally, the last piece, is here. If on a lucky day on the level 2 exam, if the case study is not too difficult, expect 1 or 2 questions here. Okay. They're saying, what is the difference in the 3 methods? Notice net income under all the 3 methods is same. And the final net income turns out to be same. Equity, same, higher. Why? Why acquisition? Correct. Minority interest. Good pick. Assets and liability, highest, lowest, in between. Revenues and expenses, highest, lowest, in between. Let me throw one more. Net profit margin. Where is the net profit margin highest? Huh? Same? Correct. Equity net profit margins are highest. That's right. Good pick. Why is that? Because under equity method, we are not consolidating the revenue. We're just taking the profit of the subsidiary. So therefore, automatically my NPM will look highest. Just be mindful of that. That's it. If the subsidiary makes losses, then your net profit margin is lowest. So it depends, of course. So yeah, you need to be a little vigilant on level 2 case studies with all those tricks. I mean, yeah, they do insert these tricks. For example, now my level 2 was long time back, but I still cannot talk. But let's create a hypothetical scenario. Let's say that you have this multinational operations reading where you have this net exposure which is positive or negative. Remember, under current method, the exposure is positive and the temporal negative. If you don't remember it, show up to the class day after tomorrow. But what if it's a company which has gone into negative equity? It's possible, no? Loss-making companies, their losses accumulate, becomes negative equity. So in negative equity, under current method, your exposure becomes negative. So these type of tricks are actually tested on the exams. So you need to be really vigilant, and that will happen if you practice enough questions. Because the thing with practicing questions is, you do a question, you get this wrong, and you think, okay, this is how also it can be tested. It gives you a different perspective. So the session is over.